Hi, everyone. Thank you so much for joining us here today. We are so grateful to have you attend these webinars. We hope that you keep attending them. Before we get started, we're just going to go over a few housekeeping items. So first and foremost, if you are here for CPE credit, you do have to do a few things in order to receive that CPE credit. You will first need to answer all of the poll questions today as they pop up on your screen. There will be 3 poll questions today. And again, if you have any issues, please just let me know. I'll help you sort that out. You will also have to fill out the survey at the end of this webinar, again, in order to receive CPE credit. So I'll tell you more times than you'd like to hear it, but you do have to do these 2 things in order to receive that CPE. A couple other important things here. As we're going along, if you have any questions, please reach out and ask those questions. We would love to hear from you. And we're going to do our best to address them at the end of this webinar. So if you wiggle your mouse around, you'll see that Q&A button. Send your questions at any time. We're going to address them again at the end of this webinar or follow up with you email if we need to. And just give me a minute here. Once we get the ball rolling, I'll be linking the slides and handouts in the chat feature. They are also already uploaded to Zoom and will be emailed to you. So a few ways to get your hands on those materials. And let's go over the pre-recorded versions of these webinars. So if you love our webinars, if you'd like more CPE credit, if you'd like to do it on your own time, we do offer these pre-recorded and you can purchase those one-off. You can also purchase the access to our Salt Vault, which will give you access to the pre-recorded webinars as well. The Salt Vault comes with a lot of value here. We have a few things listed that are included, and there's more on our website. And if you have more questions about, please reach out and let me know. I'd love to hear from you, and I'm happy to answer any of your questions. And let's do some quick introduction first for Sales Tax and More. Sales Tax and More is a full service consulting and solutions firm. We have a really great team here of experienced tax professionals who are very dedicated to fulfilling your state tax and related needs. So we do a lot of sales tax returns, sales tax registrations, consultations, research, audit defense, exemption certificate management, and like our name states, more. So if you'd like to work with us, we would love to hear from you and we would love to work with you as well. And a quick introduction for our founder, Michael Fleming. Mike's state tax knowledge is very well-rounded and he has helped thousands of companies of all sizes and in all industries and is especially well known for his work in the e-commerce industry. And Mike, why don't you take it from here?
Okay, thank you very much for that wonderful introduction, Ellie. Thank you, everyone, for joining us today. We do have a lot of information to cover. We're going to go over some use tax basics, a history of use tax. We're going to talk about the vendor's use tax and consumer use tax. There's only one use tax, but people look at it a little bit differently. We'll get into that. And then we're going to talk about some common problem areas. But before we get started, Ellie, why don't we take care of the first poll question?
Absolutely. And here's your first reminder to, if you want CPE credit, to please fill out these poll questions. And there actually wasn't a webinar last week. This is a little bit of a reschedule, but the week before there was. We hope you were there. We hope you can join us for the next installment in the series, which is next Thursday. And Mike, I'll leave this open. You can move forward and I'll close this out in about a minute here.
Thank you very much. All right, so use tax, it's a tax on the storage, use, or consumption of a taxable product or service. And when we say that it's complementary or compensating to the sales tax, what that basically means is that it's only paid if a sales tax was not paid. So generally, only one of them will be collected, but sometimes in an audit, if you get audited, then it may be paid by both the buyer and the seller. So one is a use tax, one is a sales tax. If the buyer and seller are not communicating with each other. So one of the first things we do when there's an audit is reach out to our customers when we're doing audit defense, reach out to the company's customers to see if they have actually remitted any tax as a use tax. Because if you can let the auditor know that, generally that's going to be okay. And you need to know when it was remitted, which return it was remitted on, and those types of things. All right, so use tax is generally the first or second largest cause of large assessments. The other one would be exemption certificates. So if you have a responsibility to collect exemption certificates, that's usually the leading cause for large assessments. If you don't, then it's generally going to be use tax. Um, and we said the vendor's use tax earlier. So seller may have a responsibility to collect. Just because we're using the term use tax does not mean that the seller is relieved of a responsibility to collect. And we're going to go into that in a little bit more detail. Um, if it's not collected by the seller, either a vendor's use tax or a seller's use tax or a sales tax, the purchaser may have to remit it directly to the state. They have to self-assess. All right, so let's do a quick history of the use tax. First modern day sales taxes were implemented in the 1930s, and at that point, it was widely believed that interstate commerce could not be taxed directly. I mean, even the states back then didn't believe that you could tax interstate commerce directly. So a sales tax was limited to only a transaction that happened all within a state. So when they put in these sales taxes, I live up in northeast corner of Texas, and there's a city here. It's Texarkana, and part of the city is in Texas, and part of it's in Arkansas. So let's say that a company was on the Arkansas side of the line, and Texas instituted a tax. Well, literally directly across the street, State Line Road, um, they could set up across the street and not charge sales tax. So people could walk across the street and get something cheaper by not paying that tax. So, in order to level the playing field, the state started saying, well, we can't tax the transaction directly, but we can tax for the use. So, um, if it's for the storage, consumption, or use in the state, that's not a tax directly on the transaction. So it may sound like semantics, but at that time it was a good distinction. Um, and the seller still may have had a responsibility to collect the tax if they had some sort of link or connection with the state. We call that link or connection nowadays nexus. So if the seller had nexus, even though it was a use tax, they still had to collect it. So today people think there are two use taxes, a consumer use tax and a retailer or vendor use tax, but it's only one tax. It's use tax. The difference is who's required to collect it and who's, get it to the state. So whether it be a consumer use tax or vendor's use tax, it's still the same use tax, just who's responsible for it. All right, so technically speaking, since um, the sales tax could only be within the state, couldn't cross the state line. Sales that never cross a state line have been uh, use taxes. So anything that crosses state line was historically a use tax. If it never crossed the state line, then historically that's been a sales tax. Now, this started to change in 1977 when we have complete auto transit. And that was the U.S. Supreme Court case that said, um, well, it started charging in the 50s. The 77 case is um, when the U.S. Supreme Court came in and they cobbled all of the cases together from the 1950s through 1977 and said yes, that states could tax interstate commerce directly so long as it meets a four-pronged test. And it's a pretty easy test to meet. So 1977, the lines begin to blur. And then Wayfair, back in 2018, it broke the model. And many states say that an economic nexus requires sales tax. They say that if you have a significant presence due to an economic nexus, well, it's the same as having a physical presence in our state. There's no distinction between the two. So therefore, you need to collect the sales tax. So states like Colorado, states like Illinois, where there was a big difference before 2018. I mean, a lot of times when you were collecting use tax, you didn't have to collect the local taxes. You just collected the state tax. But when these states changed, Colorado went from if you were outside the state from collecting a use tax to a sales tax, now you have to collect the locals. Same thing in Illinois and in a number of other states also. So big changes since 2018. Your customers, they don't know the difference between a sales or use tax. They just know it's a tax and you got to pay it, even within the company. The only real people or only people that really know there's a distinction between the two are the people filing the returns or doing the registrations. Um, for them, this can actually make a huge difference because if you register for the wrong tax, you may have problems down the road. If you don't know that you're supposed to be filing use tax returns and you're filing sales tax returns, we run into these problems all the time with the software companies. They're collecting the tax, they're collecting an out-of-state use tax, but they're filing consumer use tax returns, and no one is saying, "Hey, you got all this tax collected, not remitted, and it's just sitting here." So a lot of problems can happen if you don't know what type of taxes you're supposed to be collecting and remitting. So historically speaking, sales tax never crossed a state line. Use tax was all the sales that crossed the state line. Nowadays, in many states, it's blurred, but in some states, it still makes a difference. In a state like California, you still want to get registered for the out-of-state use tax versus the sales tax if you only have an economic nexus there. All right, so here's a state where it makes a huge difference and they still make a distinction. The Oklahoma vendor's use tax. So if you're a remote seller and you're required to register, you want to be registered for the vendor's use tax. It's a pretty simple process. Now, if you have an in-state physical presence, you're required to register for the sales tax. Now, here's where it gets a little bit sticky. If you're getting registered for the sales tax, you've got to be registered with the Oklahoma Secretary of State. And that's a $300 in uh, plus 300 plus fees for other required documentation. Um, you got to have a registered agent, generally going to be somewhere between $99, $350. There you got to pay the actual state fees. There's an annual franchise tax return that you have to do. It's generally going to subject you to income tax when you do all of these things. Plus, the Department of Revenue itself charges you $25 for a sales tax license. They don't charge you for a vendor's use tax license. You don't need a Secretary of State. You don't have to worry about income tax if you're getting registered for the vendor's use tax. Now, a while back, not all software companies are of the same level. Even today, they're not of the same level. We call them two tiers. You've got an Avalara and a Vertex. Those types of companies would be your tier one. They've got their own problems and everything else. But the tier two companies, a company like a tax jar, they can't file or they couldn't file. I don't know if they can now since Stripe took them over. I can't imagine that it's gotten much better. But they didn't know, for some whatever reason, they couldn't file an Oklahoma vendor's use tax or any use tax returns. So the salespeople would just say, "Oh, just go and get registered for the sales tax so we can file your returns." And people would have us do their registrations, and then they'd find out from TaxJar that they couldn't do it, and TaxJar just told them to switch it. And they'd call us up and say, hey, you did this wrong. No, we didn't do it wrong. We did it right. Tax is doing it wrong. And the tax would tell them no big problems. And there's no big problems when you switched it initially, but at some point, the state comes back and says, hey, you're supposed to be registered with the Secretary of State. Hey, you're supposed to be paying income tax. Hey, you got all these other fees. So it does make a difference. You're going to hear me talk negatively about some of the things that software companies do. If you've ever listened to me before, that's one of my big beefs. If you are going to work with a software company to do anything other than figure out the rates and taxability, you got to know who you're working with and do they have the ability to do everything that you need them to do. So that's my big caveat here. Not all software companies are created equal. All right, so in Illinois, we said that in complete auto transit, there's a four-pronged test to see if a tax is constitutional or not. And I said it's a pretty easy test to meet. Well, Illinois is one state that has run afoul. And I think that the way that they're implementing this right now is unconstitutional. I've been saying it for years since they've done it. Finally, we had someone last year who's challenging them on this. I think it'll work its way through the courts all the way up to the Supreme Court, and I think the state of Illinois is going to lose. We still recommend to our clients to continue doing this, even though it makes things a lot tougher, and I'm going to get into that in a second. But the fix is too easy, and states could make the fix retroactive. So that is why we say, even though we believe this is unconstitutional, to continue doing it. So um, remote sellers are required to register for the retailer's occupation tax destination based. They used to sign up for the retailer's use tax. But once this law passed, they had to sell for excuse me, register for the retailer's occupation tax. And that's what they call their sales tax. Now, when you do this, it requires reporting to almost 4,000, if you're selling all over the state, almost 4,000 local jurisdictions. So not only do you have to figure out the rates for those 4,000 jurisdictions, when you're filing the returns, it's a nightmare. We had to hire 3 or 4 extra people just to file our Illinois returns because of all of the extra work. Um, so that's for the retailer's occupation tax destination based. Now, if you have a warehouse in the state, sellers shipping from Illinois are required to register for the retailer's occupation tax, origin based. And what that means is you only have to worry about one rate and one location on the return. That's a huge difference there. So one of the prongs of the complete auto transit is the tax discriminatory? And we believe this is discriminatory. You're discriminating against interstate commerce. You're making it real easy for the in-state company, and you're making it real hard for the remote companies. So we that's why we believe it's unconstitutional, and we think that this is going to be overturned. But like I said, too easy to fix, and it might be fixed retroactively. There was a loophole here, and sellers with a physical presence, but they didn't have a warehouse from which they were shipping, they were still allowed to register for the retailer's use tax. And we used to tell people, go ahead, send a salesperson in there, create some sort of physical nexus so that you didn't have to worry about these 4,000 local jurisdictions. If you were having someone like us do the returns, then it didn't matter. But if you were doing the returns yourself, you wanted to figure out some way to go around this, but they closed that loophole. You can no longer, if you have any type of nexus with Illinois, you can no longer register for the retailer's use tax. You have to be registered for the retailer's occupation tax, and it's just a matter of whether you're going to be doing origin based sourcing or destination based sourcing. All right, Ellie, why don't we go to the next poll question?
Absolutely. Just a quick true or false question here. Use tax is a storage use tax is a tax on the storage, use, or consumption of a taxable product or service. True, false, or it depends. And Mike, if you want to review this one quick, I'll leave it open for about a minute after you're finished, and we can move forward when you're done.
Although it depends is my favorite answer, and I use it quite often. In this case, the answer is true. Use tax is a tax on the storage, use, or consumption of a taxable product or service, as opposed to a sales tax, which is a tax on the transaction. All right, so consumer use tax. Only exempt purchases are tax-free. Just because the seller doesn't charge you any tax does not mean that it's tax-free. Maybe they don't have Nexus and they weren't required to collect a tax. Maybe they didn't know they had a requirement. Maybe they didn't know that it was taxable. For whatever reason, if you're not charged tax, you got to look at the transaction. Is this a taxable transaction? And if it is, then you need to self-assess. You need to accrue that tax and remit it to the state yourself. And that is what we refer to as the consumer use tax. Now, this is not, it goes for individuals as well as businesses, but individuals aren't audited where businesses are. This is one of the reasons we even had Wayfair, because all of these states wanted some of that remote revenue, and the consumers were not paying their use tax. So that's why the burden got shifted. Now, for businesses, they are audited. And as we said earlier, this is either the number one or number two reason for large assessments. And when an auditor comes out, they're not only looking at what you're selling, they're not just making sure that you're collecting all of the tax you should be collecting, and that all of that tax is actually being remitted to the state. They're looking at your purchases also, and they want to make sure that uh, all of these transactions that you're involved in, that you're making these purchases, that the tax is either being collected by the seller or being sent to the state directly by you. Can't say enough. This is a huge problem here. All right, so uh, we basically just went over this. They're not just looking at the company sales to make sure that enough tax, but also at the purchases. Um, Expenses and fixed assets, they're going to be reviewed by the auditor. So you've got to make sure that you're looking at all of these things. Um, so the I'm going to tell you an auditor joke here, and this is auditor humor, so it might be a little bit dry. But we were working on an audit, and it was for a manufacturer. And there was one office that was making the purchases pretty much for the entire company. And they were buying hundreds and thousands of dollars worth of toilet paper. And this person in the um, accounts payable department thought they were saving the company a whole bunch of money because they knew that manufacturers didn't pay a whole lot of tax on things. So they were short paying all of the invoices for this toilet paper. Well, the auditor came to me and he says, "Hey, Mike, I know that, toilet paper is used and consumed, but it's not used and consumed in the manufacturing process. So therefore, it's going to be taxable." And he had a quick little laugh, and unfortunately, it was true. So can you imagine this woman who thought she was, saving the company all of this money and everything else, and now she's got to go back to her boss and say, "Hey, I thought I was saving the company a lot of money, and I didn't, I short paid all these invoices for the tax on the toilet paper. Now we've got to pay all the back tax with the added insult of penalty and interest." So, um, that's one of the reasons why this is such a problem for large assessments. Not everybody knows that they should be self-assessing and remitting that use tax. All right, so some common problem areas. When you're purchasing software, this, sorry, got distracted there. When you're purchasing software, it may be taxed to one location or not taxed at all, and it's often used in multiple locations. So wherever it's being used, you're supposed to be submitting the consumer use tax to that state. Purchases of services. Multi-state providers often don't know the multi-state taxability. Sometimes it's not taxable in their home state, so therefore they don't charge you tax. And we were involved in one audit, and the company was furious that they weren't charged the tax. Well, just because someone doesn't charge you tax doesn't mean it's tax-free. You got to know the taxability not only of the things you sell, but of the things that you're purchasing. Um, Opening new locations. When you're opening a new location, whether you're a new business or you're an existing business, there's a lot of purchases that are made. And many of these purchases slip through the cracks, and no tax is paid on them. New construction, same thing. The contractor is often considered the final consumer. So contractors, big problems for them. They're not charging tax to their customers usually. They're supposed to be paying the tax on their materials and supplies. Now, it gets a little bit more complicated than that. It can depend on the type of contract, can depend on whether it's residential or commercial, can be new build or repair, remodel. So it's not that straightforward. But in general, we see the most problems when it comes to use tax with contractors. Now, auditors, they know all these things, so they look for announcements. Who's expanding? Who's opening new office? What business is just starting? And they also review permits. So they can go down and look for all the building permits, and whoever's got new building permits or um, all sorts of different types of permits, and they use those as lead sources. So these are some very, very common problem areas. Um, some more common problem areas, renovations of existing locations. Again, anytime you're making a lot of purchases, these can be problem areas. And when you're doing renovations, again, sometimes you got to have a permit. Many manufacturers' employees think that all purchases are exempt. That's just not true. Generally, it's going to be items that are used and consumed in the manufacturing process. And the process is different. The definition for that is different between the states. So what may be exempt in one state is not exempt in the other. Forklifts in one state, they may be exempt for whatever purpose you're purchasing them for. They're going to be used in the warehouse. In the state of Texas, they're not. That's considered intra-plant transport. It's not directly used in the manufacturing process. So lots of problems for manufacturers just because they don't know the taxability in all the states that they're involved in of the items that they're purchasing. Now, contractors, sometimes their project is going to be taxable. Sometimes uh, uh, they're going to be considered retailers. But most often, like we said, they're going to be viewed as the final consumer. And then you're paying the tax on the purchases of your supplies and materials. Service providers. Sometimes the products they purchase are eligible for resale. This is most often the case when the service you're providing is taxable. And nowadays, more and more services are taxable in more and more states every day. Our economy has basically shifted from a manufacturing base to a service-based economy, and the states want to play catch up. So more and more states are taxing more and more services. When the service is being taxed, the items that the service provider is purchasing, they can often buy tax-free. But there's still a lot of services out there that are not taxed. And when that's the case, the items that the service providers are buying, you generally need to pay tax on them. And if you don't, then you need to remit it to the state directly as a consumer use tax. Now, out-of-state purchases. You can purchase some in the state of Texas and you're going to use it in the state of Oklahoma. Well, carrying that property into that state can subject it to a use tax. Now, generally, you can take a credit for tax legally paid to another jurisdiction. So if I had it delivered here in Texas and the tax was legally due here in Texas, the sales tax, then when I bring it into Oklahoma, I can take a credit for the tax that I paid in the state of Texas, that sales tax. Now, if the sales tax is at a lower rate than the state I'm bringing it into, I've got to pay the use tax on the difference, that higher amount. So even though I get a credit, it's not going to cover all the tax that I would owe. So I still may owe some tax. Now, going the opposite way, what happens if this tax was higher in the state where I had it delivered and it's lower? Well, there's no refund or anything like that. You're just covered. There's nothing additional to pay. And this trips up a lot of companies. They don't realize that when they're bringing items into another state, remember, this is not a tax on the transaction. It's a tax on the use, storage, use, or consumption. If I'm using it in another state, then there could be a use tax that's due in that state. Intercompany transfers. This may be disregarded for income tax, doesn't mean it's disregarded for sales tax. And transactions between an entity and a parent entity can be taxable. Transactions between sister corporations can be taxable. We run into this type of issue all of the time. People just don't think, well, we're going to loan it to them and we're sending it from Minnesota to Texas. I was involved in an audit. They were moving heavy earth moving pieces of equipment. They were building highways, and the state of Texas went after them for the use tax. And the company was just like, we didn't even think of it. And a lot of people don't. And that's why these are common problem areas. Mergers and acquisitions, different rules for different states. Definition of an occasional sale is different from state to state. In some scenarios, it depends on whether the seller paid tax on the purchase. Sometimes it doesn't matter at all. So you really need to know the rules for each state that you're working in, and it can get very granular. We've been talking about contractor issues. So whenever something is someone's incorporating materials into real property, they become a part of that real property, and they're generally not taxable to the customer. In certain circumstances, they are. We never want to speak in absolutes, but generally, they're not going to be taxable to the customer. And in that case, the contractor is usually deemed to be the final consumer. And if the contractor is the final consumer, they need to pay sales tax at the time of purchase. And if they don't, they need to self-assess and remit it directly to the state as a use tax. Now, for contractors and manufacturers, it can get a little bit sticky. What's the basis of the tax? If you're making something, is it based on the raw materials? Is it based at the price at retail? Well, the answer on this one, like I said earlier, my favorite answer is it depends. Depends on the state, depends on what the contractor is doing, what their business model is. Are they actually selling at retail as well as acting as a contractor? So lots and lots of variables in here that'll change what the basis for your tax is. All right, so how do we protect ourselves? Well, you got to have a consumer use tax accrual process, and How do you want to do this? Do you want to review all invoices? This is usually done when the number of invoices is manageable. I mean, sometimes companies make large purchases, but they don't make a lot of them. And at that point, you want to look at all of the invoices because, um, if you're making large purchases, then it could have a major impact. Um, Not too many companies are in that position though. So a lot of companies say, okay, all invoices over a certain dollar amount, and it's going to be different for every company. We're going to look at all of those. So 100% of the invoices over $5,000. Now I'm just pulling that number out of thin air. And then on anything smaller than $5,000, we're going to do a sample. They also may look at certain vendors. Certain vendors, if you know a vendor charges you the wrong tax all of the time, or is overcharging you or undercharging you, you want to target these vendors. If you know they're going to be a problem, why wait until the auditor tells you about it? Be proactive. It's going to be cheaper in the long run. And then you always want to review all of your fixed assets. Um, you're going to want to review all expenses over a certain dollar amount, and then sample some of the smaller expenses. Now, this is one area we're not shooting for perfection. If you're shooting for perfection, you'll probably have the law of diminishing returns kick in. You'll be spending more money trying to catch every possible case. And when we're talking about a $2 purchase, how much time do we want to spend on that? So we're not looking for perfection here. We just want to catch the majority of it. Couple ways to put a process in place. You can have a manual process, you can have an automated process, or you can blend the two, or you can outsource it. Now, a lot of the software companies out there, they're going to tell you, hey, just use our tax software and it can do it all for you. However, you got to really look through that sales pitch because it may be able to do it all for you if you make drastic changes the way that you collect information and enter into your accounting systems. Very few of the systems that I look at out there can take the information the way that most companies are putting it in and do this all on their own. A manual approach may be okay with a limited number of transactions. Um, I think the blended approach is usually the best source for most companies out there because software can, while I don't believe it can do the job by itself, I do believe it can make the job easier for anyone tasked with managing the process, especially when there's a number of large transactions. So we suggest either a blended approach or an outsourced approach. Trying to do this manually when you have a whole bunch of purchases, that's going to be tough. Turning this over to a software company, 100%, that's not outsourcing. You need an actual person going through here. You can't rely on software by itself, in my opinion, unless you want to make wholesale changes to the way that you're entering and collecting information. Okay, so the ideal person tasked with managing the use tax accrual process, they've got to have a basic understanding of tax. They have to have access to some type of taxability matrix or taxability software, and they have to have the work spot check from time to time. Because you can have the best process out there, um, but if people aren't following the process and you don't know that they're not following the process, well, you might as well not have a process. So you got to spot check it. You got to make sure that they're actually doing and following the process that you set up for them. And again, we're not looking for 100%. We're not looking to catch every single item. We're just looking to collect most of them. So that's the way that your process should be looking. As I've been saying, perfection is not is not the goal. Preventing 100% of potential use tax problems, just not realistic. At some point in the future, it might be. Software is getting better and better all the time, but as of right now, there's just too many limitations. And sometimes the software may be okay, but it's limited because it needs the information provided to it in a certain format. And sometimes it's just cost prohibitive for us to make the changes so that the software can do it on its own. Um, we're looking to prevent the majority of the exposure, the big picture stuff. So not 100%, but if we're catching 80% of the issues out there, we're generally going to be okay. Um, you're looking to prevent 100% of it on the big stuff. If you're looking at all invoices over $1,000 or $5,000 or $100,000, that's where you want 100% of catching it. But the smaller stuff where you're doing the sampling, that's where the perfection really is not going to be the goal. Now, a lot of people, frown on being compliant here. They're saying, well, if we're going to end up paying more money, so this is sometimes not viewed as a very glamorous position because you're not making the company any money, you're just costing the company money. However, if you have a good process in place, it's not always about paying the tax. Sometimes it's about not paying the tax. For example, taxability is very, very confusing. So when it comes to a gray area, some companies say, when in doubt, we're just going to tax. And maybe that something in your state is not taxable. So in that case, you either want to short pay it um, or ask for tax refunds if someone else is actually paying the tax for you. So this can also save you money. And this is the piece right here, the tax refunds and the short pays on the invoices where you want to do it. You don't want to be like the toilet paper lady and do it where you shouldn't be doing it. But there's a lot of times where this is really good. So if you set up a system and you're doing it correctly, not only are you looking to prevent issues down the road, but you're also looking for ways to save money. All right, Ellie, why don't we do the next poll question?
All right, and we just want to know if you're going to be joining us for our next webinar, which will be next Thursday. We hope to see you there. That'll be part 5 of the series. And there's a link if you get the advertising emails for these webinars. There's a link in there. I'll also send one out with the follow-up email so that you can make sure to sign up pretty easily. And we hope to see you there. Mike, I'll leave this open. You do have to answer this question in order to receive CPE. Mike, you can move forward and I'll leave this open for a bit.
All right. So here's some common process problems. The training of people. I mean, it's not easy, getting someone up to speed on taxability and, learning your process that you've set up for them. And as soon as you get them trained, then they're leaving it. They're going on and using the skills that you've taught them someplace else. So the turnover of trained personnel, these are usually positions that have high turnover rates. Processes not being followed. Like we said earlier, you can have the best process in the world, but if it's not being followed, then you might as well not even, have a process. So these are some of the common problems. Taxability complexity. It's one of the areas that I see companies struggle with the most. They have a hard time when they're selling an item, getting their arms around the taxability sometimes. So just imagine, multiplying that. How many different items do you buy? And having to know the taxability on all of that. So that's a very common problem. And then information sharing. Sometimes, the person tasked with managing this doesn't have all the information they need, and it can get siloed. The person making the purchasing decision doesn't share it with the person who's actually in charge of the use tax accrual program. They may not be the same person as the accounts payable person. So just sharing information with each other, or having the ability to share that information, or having that information accessible by multiple people can solve a lot of problems. All right, so I'm going to give you an example of how tough use tax can be for companies. This was a number of years back. This was before Wayfair, and we had a number of clients contacting us. They said John Deere contacted them and said they no longer work with any vendors who don't charge them sales tax. And, I'm using John Deere here because everyone knows, or most everybody knows who John Deere is. But this is not uncommon for companies to take positions like this. They were having so many problems. It was so complex. They just said, you know what? We want everyone to charge a sales tax. And if you're not charging a sales tax, we don't want to do business with you. So the calls we got were like, well, can they do this? Can they make us charge you sales tax? Our answer was, yeah, John Deere can do whatever they want. They don't want to buy from people who are not charging them sales tax. That's their prerogative. So we had a lot of questions, and people were like, well, can I just collect sales tax on John Deere and, not worry about my other customers? You got to remember, this was before Wayfair, before an economic nexus. And our answer was, in most states, virtually all the states, you can't do that. Once you get registered to collect sales tax, you have to collect it on all your customers. You can't pick and choose who you're going to collect the tax on. Um, so a lot of companies were like, should we get registered? Well, we said, you got to look at how this impacts your business. And if John Deere is a major percentage of your business, then you probably want to go ahead and get registered. If they're not such a big um, part of your business, then you got to look at how this is going to impact your business. So most everybody we talked to went ahead and got registered. But there's one company that said, they're less than 0.5% of our business. We think this is negatively going to impact us. We'll have to collect sales tax everywhere. Again, this was before Wayfair. So we're not going to get registered. And I don't know if John Deere did business with them or not. But that's how big a problem this is. You get a big company like John Deere with a big tax department, and it's so complex for them. They said, we can't deal with this anymore. So we want everyone to charge us sales tax. All right. So Ellie, let's open it up to questions at this time.
We don't have any right now. Is there anything else you want to go over?
No, I just want to thank everyone for joining us today. I hope that this has been beneficial. And if any questions come to you, after we end the webinar today, just email them over to Ellie and we'll see if we can get a quick answer for you. Quick answers are not always what you want. Sometimes you got to do a little bit of digging. We know a lot of information here off the tops of our heads, but we can't possibly know everything. And sometimes you just don't want an off the top of the head answer. You need a little bit more in-depth answer. But we're pretty good at off the top of the head answers, and a lot of the questions you have can be answered off the top of our heads.
Thank you so much, everyone.
Thank you. Take care.